Hey!
Hey guys.
It's Jonathan and Hugh.
Hey, what's up, y'all?
We're here to do our next episode of Hugh Knows for March. And just like always, we wanted y'all to know that this is Bunk and Baker Mortgage Group. We're a DBA of Network Funding. So all these episodes are our own opinions. They do not reflect the opinion of our leadership, our parent company, Network Funding. But we have a great episode today, Hugh.
Absolutely.
A lot has happened.
Yep. Exciting day in the markets. So let's jump into it. So just going to that first slide, I'll just go quickly over the overview. And basically the first thing that we're going to talk about is what is going on right now in the equity markets, what's going on with this bank failure with SVB, the Silicon Valley Bank, and as well as another bank that failed. So we'll look into that. We'll also look at some of the macroeconomic data that we've continuously sort of kept you all up to date on, inflation, yield curve, and that sort of thing. And then we want to pivot away from that, look a little bit more at some mortgage analysis, look at what's the state of the current mortgage market. And then after that, we're going to dig into looking at real estate over a long term of a really long period of history, kind of taking a historical view. I think there's some interesting takeaways from that. And then we're going to end with home prices and interest rates. So with further ado, let's jump into our first segment, which is SVB and the fallout. So what is going on with this bank? Okay,
it has been bananas.
So if you look at this, next slide, we've got some headlines, some things that have come out in the news over the past few days. So what essentially happened with this bank is it was a technology focused bank. They had a lot of technology investors in it. And basically, they didn't manage their assets well, and so there was a run on the bank. So that means that people went in and tried to all take out of their money at the same time, and so basically that caused the stock price of the bank to collapse, and the bank itself was insolvent. And so the federal regulators had to step in and actually take control over the bank. And unfortunately, it didn't actually stop there. There was another bank that was associated with this Silicon Valley Bank called Signature Bank, and that one has also been taken over by regulators. So this is a pretty big deal. It's kind of like the 2008-2009 beginning of that financial crisis when we saw Lehman Brothers go under. So yeah, what are your thoughts, Jonathan?
Yeah, there's a lot on the screen right now, but SVB is Silicon Valley Bank. And so the crazy thing to know about this story is that it's the 16th largest bank in the U.S., and it's the second biggest banking failure in our history after Washington Mutual, which happened back during the great financial crash. And so this is a big story. And when you have a bank, a lot of your money is through depositors, people putting their checking, their savings, their money in their businesses or personal people. And FDIC, which a lot of people hear about, like, what is FDIC? It means the government's insuring your deposits. Well, SVB had, 60 billion deposits, and only 5 billion were FDIC insured. And so 90% of people who had their money in that bank right now are like, you're not getting it back. And so the government had to step in. That happened, we're filming this on the 13th, so yesterday was March 12th and Sunday, and the government stepped in overnight. The Fed did. And what I think was happening right now is the Federal Reserve, all the Fed policies, been fighting inflation, been rising the federal funds rate. I think they realized the path that we've been taking, the federal funds rate, is starting to crack some of our financial system and our banking system, which is not good for our country. It's not good for our economy. And so a lot of things are going to happen going forward because of this event.
That's right. If you look at the news today, you'll see that the financial sectors where the banks are located in our economy, that's doing very poorly today. There's other banks that are seeing large decreases in their share prices. So definitely starting to see some cracks in the financial system that are worrying, at least from the Fed's perspective, and that might change their policy going forward as it regards to interest rates. And you can see on the screen right now on the bottom left, you can see there's a headline that's basically saying because of this Silicon Valley Bank's failure, Goldman Sachs is now predicting that the Federal Reserve will not increase rates at all at its next meeting. So if we go to the next slide, this one's a little bit of a complicated slide, but we'll walk you through it slowly.
Yeah.
Basically, what the slide is showing is the market's expectation of what the Fed is going to do at its next interest rate meeting. And the expectations show a month ago, a week ago, last Friday, and then as of today, so as of this morning.
Yeah, and the big thing to note is we know the Fed's been raising rates, we're fighting inflation, right? And so everybody's like, what they're going to do at the next meeting. So everybody's trying to survey what's the probability, and the market's always moving ahead of what they think the Fed's going to do. And so as new things happen, jobs data, inflation data, banks failing, the market's going to change the probability of what the Fed's going to do. And so this survey is kind of breaking that down, right?
Right, yeah. So you can see in the very lightest blue bar in sort of that middle part of the chart, basically that's what the expectations were a month ago. And if we go back a month ago, what had happened? We had a really hot jobs report for February. So the market had looked at that and said, okay, that's not good. That might means that the Fed is going to increase rates even more. And then we had a hot not such great inflation reading.
Yeah, decelerated
disinflation. So inflation wasn't coming down as much as we wanted it to. And there have also been some other strong data points over the past couple of weeks that have basically pointed in the direction that Fed is going to increase rates quicker and maybe keep them higher for longer.
Yeah.
And so what you can see is, then, if you look at the right-hand portion of the chart, that darkest blue bar, that represents the expectation of the federal rate hike for March last Friday. So last Friday, 40% probability of seeing a 50 basis point increase, and today nobody's even expecting a 50 basis point increase.
Went from 40 to 0.
You can see that now, as of today, there's a 10% probability. You can see that on the left-hand side of the chart of no interest rate increase at all. And
wait, we got to stop there. You hear what Hugh just said. There's an actual legit survey that people think the Fed might pause now. So like literally a week ago, we're talking 50 bips. 25 was 100% guaranteed for the next couple of meetings. But now because of this SVP bank failure and all these other regional banks, and now we're talking about a pause?
Right, yeah.
It's crazy.
Big changes as far as the interest rate. So the point here is that the market is now expecting at worst a 25 basis point increase, and now a portion of the market, at least a 10% probability of seeing no increase at all. So that's great.
Yeah. So if you've been following mortgage rates, we've been going up and up and up because people are seeing the jobs data come out, the inflation data. Like, man, the Fed's going to hike higher for longer. That's what we've been hearing. They're going to do 50. It might do 25 in the next 3 meetings. Just the fact that now we're talking about a pause, the market is going to soften. And so we think we might see a little low here, hopefully, in the coming weeks on mortgage rates.
Yeah, we think that we'll see improvement in mortgage rates.
So if you're a realtor or a home buyer, we don't like seeing banks fail. If I had my money in that bank, I'd be upset. We don't like seeing these things. But if you're a home buyer or realtor, this is a good thing for mortgage rates right now.
Mortgage rates are likely to come down because of this. Okay. So that's it for that segment. Just a recap on what's going on in the equity and bond markets today.
Volatility.
Some risk out there. But now let's move on and check out the macroeconomic context. Okay, so on this next set of slides, we'll first start with inflation. Okay, so this is back to the bread and butter of what we've been talking about for the past few episodes here. And of course, you can see on here I'm plotting the two measures of inflation that are very widely used. That's the Consumer Price Index and the Personal Consumption Expenditures Index. Now, we can see, looking back last year, we're starting to see a general trend down for both of these measures of inflation. But you do see in January kind of both of those measures starting to level off, which is worrying news because we want to see a decrease in that inflation because it's still, even though it's come down versus where it was last year, middle of last year, it's still too high. So
yeah, and the goal is the Fed. I mean, Jerome Powell's been saying 2%. The goal. So if you look on the chart on the y-axis, it's like we're trying to get to that 2%, and so that's the goal. But how we get there, when we get there, that can change. And obviously, if you have financial crises, you can see inflation getting back lower much quicker. For instance, when we had the Great Recession in 2008, 2009, we started to see inflation come down if the banks and financial system's broken, people can't borrow money.
Right.
If people can't borrow money, they can't buy things. So price stability, and that's what the Fed wants to see.
Yeah, exactly. So we've seen improvement on inflation over the past few months. We would like to continue to see that. And of course, there's a big asterisk with what is going on in the financial markets with these banks.
Yeah, I actually read this morning that they think mortgage rates, we're talking about mortgage rates here, and the mortgage-backed securities market might be more affected by what happened with the Silicon Valley Bank and all these other regional banks than the CPI data. So we've been talking inflation data. Inflation data is driving everything. And you can see here we have January's data. February's data is coming out in a couple of days this week, like March 14th, I guess, tomorrow. But they're saying what the Fed's doing to help the banks out, and the banks' failure is now the number one driving story of mortgage-backed securities and mortgage rates. And so that is a huge shift in the narrative.
Yeah, the increase in the federal funds rate is one of the reasons why Silicon Valley Bank actually became insolvent. So the Fed is having to balance.
It's like we did a little too much, I guess.
The Fed is having to balance multiple considerations.
Yeah.
Okay, but now moving on to this next chart, one of the big things that the Fed has been focused on is the labor market. And of course, what we're looking at here on this slide right here is the unemployment rate, which is plotted against the left-hand axis, and then the labor force participation rate, which is plotted against the right-hand axis. The big point here is that the labor force participation rate, where it is right now, has not gotten back up to that pre-COVID average, which I'm indicating in that orange arrow on the chart right now. So there's a gap between where the labor force participation rate was prior to COVID and where it is now. And so if you have less people that are actively looking for jobs in the workforce, you're going to have a tighter job market, and that's going to keep unemployment lower, which is one of the things that the Fed has been focused on. You have this strong labor market, again, lots of open jobs, but not enough people to fill those open jobs.
Yeah, exactly. So we just want to highlight this one real quick, and then we'll jump into the next one. So you've probably been hearing the word yield curve inversion or inverted yield curve, all of this. What that is talking about is the 2-year Treasury yield and the 10-year Treasury yield. And you just got to think logically, if I give you my money for 10 years, I should get a higher return than if I give you money for 2 years. And historically, that's the norm. But right now, the 2-year Treasury yield is higher than the 10-year Treasury yield. So it's like I make more of my money if I give it to you for 2 years than 10 years, so that doesn't make sense. So it kind of throws off a lot of things in our economy and our financial systems, and that's what we call an inverted yield curve, which historically an inverted yield curve, right, Hugh's been a prediction of what?
Recession. So typically when the 2-year yield is higher than the 10-year, usually we see a recession within 5 to 24 months after that yield curve inverts. And it's basically saying that if the 2-year is higher than the 10-year, that means the market's sort of pricing in some extra risk over the near term, which is why that 2-year yield is higher. But we've seen that inverted yield curve. It's actually kind of the deepest it's been for a long time. The deepest it's been since 1980.
Yeah, you can see that right there, how deep it's gone.
That's
on the
right.
chart.
In those shaded boxes, I'm showing the different periods when we saw the yield curve inverted. But this is something that we continuously keep our eye on, and it's something that we want that you to be informed about, and just to be aware of that this is something that's going on in the market and something that we need to pay attention to.
Yeah, I mean it's 2023, and this is the deepest, the biggest gap the 2-year and 10-year I've ever had since 1981. I was born in '87, so it's like I'm 35. This is the first time in my lifetime it's been that deep. And a lot of people have been like, are we in a recession? Were we in a recession? Are we about to head into one? No one really knows. They don't say that stuff until years out of it. If you're in the real estate or mortgage business, I feel like since July of 2022, we've been in a recession, and probably till July of this year, we'll kind of feel like it. So we might have already gone through the recession 50%. And then the thing we've always shared is just because there's a recession, just because of the yield curve inversion, does not mean home values are going to go down. 4 out of the last 6 home values have gone up. But,
during the recession,
But we just wanted to share this chart and show you kind of what is going on. And this was as of March 10th too, Hugh. I looked at the Treasury yields this morning as recording on March 13th. They've already dropped dramatically, the 2-year and 10-year. They're still inverted, but they both have dropped significantly. So these things are
a lot of dynamics happening right now.
These things are moving fast.
Absolutely. Okay, so moving on to this next segment where we're going to look at some analysis of the U.S. Mortgage market. So on this next slide, you're going to see on the left-hand chart, and we showed this on our last episode, it's basically the foreclosure rate. So how many mortgages there are versus how many are being foreclosed on. We saw a little bit of increase in 2022 versus 2020 and 2021. The reason for that is there was a moratorium on foreclosures for a while because of COVID, and that was lifted in large part in 2022. So we did see an increase, but overall still very low versus the historic level as far as foreclosures. And then on the right, we also showed this last time, and this basically shows the mortgages by delinquency status. So you can see how many mortgages are 30 days later in their payment, 60, 90s, 120 plus, and then which ones are actually in the foreclosure process. And you can see that we're still at a really low level, and in fact, at the last reading, it kind of dipped even lower. So that's just a recap of what we showed last month. And then on the next slide,
and the big thing to know about this is don't read into the headlines. Foreclosures are up year over year. Delinquencies are up year over year. Things are just normalizing, and so we don't think we're going to see a lot of foreclosures happen. And foreclosures usually drive inventory, and so we're just trying to share with this data that things are just normalizing. Don't get off. What do they call that? Clickbait and all the headlines. So
the foreclosure rate increased significantly.
Don't read into any of that. Foreclosures are still way down, huge historical lows, and they're not going to come anytime soon, in our opinion.
And this next slide, that point is supported. You'll see on the left-hand chart, basically it's showing mortgage originations by credit score. And you can see in the past, like in 2008, 2009, a lot of mortgages that were being originated had very low credit scores versus where we are today, where the vast majority of mortgages that originated have a very high credit score. So they have very good credit. And then the chart on the right is basically showing the amount of equity in U.S. homes, where it's showing U.S. equity prices versus debt values, so their mortgages versus how much the homes are worth. And you can see that currently there's a large amount of equity buildup in U.S. homes on average, and so you would have to see a really large decrease in prices in order for you to see mortgages go underwater, which is really what oftentimes drives foreclosures. So again, another indicator that we're unlikely to see foreclosures increase significantly.
And so after the great financial crisis, 2008 and all that, the Dodd-Frank Act came out and really changed the guidelines to get approved for a loan. So the important thing to note here is the people that own a house are very qualified borrowers. Great FICO, great jobs, probably put down a decent amount of down payment, and the equity chart shows how much money they have. So it's like, we're not going to see foreclosures because the people who have homes are in great situations.
And they have a lot of equity.
Yeah.
Okay. So moving on to the next segment. What I'm showing here is an index starting in different decades, so multiple different indexes, starting in different decades of real median U.S. home price changes. So if you start in a specific year, like 1971, for instance, in that dark blue line, and you plot the real changes to median U.S. home prices, you can see how that changes from a value of 1 throughout time. And what this is basically showing is that a sort of strategy of buying and holding real estate over a long period of time yields a return on a real basis, so an inflation-adjusted basis, for an investment. So the basic point here is that, while maybe not owning a piece of real estate over 2 or 3 years is going to give you a really great return, over long periods of time, real estate really does hold its value.
Yeah, so the old Warren Buffett saying is, don't wait to buy and wait. And so that's kind of what happens when you own real estate. If you're renting right now, you're missing out on growth. You're missing out on equity.
Right. Yeah, so on the next slide, what we basically do is we show the same data, but we're showing it all on a base year of 0. So all of the different indexes starting at year 0 and then plotting them out over 12 years. And you can see, like I just said, that if you're trying to buy and sell in 2 or 3 year period, you might not see a great return. In fact, it shows that oftentimes you see a negative return on a real basis anyway, inflation adjusted basis. But as you hold over time, you start to see those values increase, and holding real estate for long periods of time is a good way to see a strong, a significant return on investment. As you can see, all the lines are basically over 1 as you hold past 8 years.
Yeah, and so we always tell borrowers, if you're moving to Houston, you're buying a house, if you're not going to be here for 3 years or longer, it might not make sense to buy a house. And that's, obviously we'd love to do your mortgage and get paid on it, but we're here to truly advise and be authentic and help your financial situation. Because if you bought and then sold in 2 or 3 years, there's costs involved with buying real estate, there's costs involved with maintaining real estate, and then there's costs involved with selling real estate.
Right. And
so if you try to do that in a year or 3 year period, you could end up negative.
That's right.
But if you're buying for 5 or 7 years or longer, then likely you're going to make a really good return on purchasing that real estate.
Yeah, and that's really backed up by the data. So, all right, now we'll move on to the next segment. And in this segment, we're basically going to focus in on home prices and on interest rates. So this is a chart that I think is sort of like a helpful model or heuristic that you might look at when you're thinking about interest rates and buyer demand. So basically what I'm showing here is the 30-year fixed rate throughout time going back to 2019, and that's the orange or yellow line that you can see on the screen. And then I'm showing what level of buyer demand you can expect at that interest rate. Now, some people might think, okay, look, if you have real higher interest rates, then you're going to have a lot weaker demand. But that's actually something that isn't necessarily totally borne out by the data, as we'll get into in just a second. So while this might be like a helpful, just sort of like first glance, it might be helpful to think as interest rates go higher, then you should expect to see lower buyer demand. If you look over long periods of time, changes in interest rate and buyer demand aren't strongly correlated. So we'll jump into that in just a second.
Yeah, and I think two things I take away from what happened last year, even what's happening this year, is like as rates go from 4 to 5 to 6 to 7, there are buyers that emotionally just like, I can't grapple with these interest rates, even though our outlook is houses in Houston are probably going to go up in value. But people emotionally I think once we got to 7, some people are just like, I'm tapped out. And so you saw demand maybe pull back a little bit. But also higher interest rates, some people just don't qualify for the payment. When rates dropped into the 5s, back in early January, we had that little dip, or it was like February 1st or 2nd. Fannie and Freddie said that 3 million home buyers are now eligible to get financing that couldn't because of higher interest rates. And so I think anecdotally, we know as rates go back to 6 to 5, more buyers will come into the market because they qualify, or now they can just emotionally digest that interest rate.
Right. All right, so on this next slide, basically what I'm showing here is the 30-year fixed rate going back to 1971 and the change in median U.S. home prices adjusted for inflation. So the change in U.S. median home prices, that's going to be on the right-hand axis, and then the actual 30-year fixed rate is going to be on the left-hand axis. And the point here is that basically you can see changes in home prices go up or down. And still have higher or lower interest rates. There's not a strong correlation between changes in interest rates and changes in home prices. So you can have periods where you have really high interest rates and housing demand or housing prices can be increasing. You can have a period of low interest rates and housing prices can also be decreasing. So it's not strongly correlated is basically what I'm saying. So if you're thinking about buying, the takeaway would be
buy now.
Yeah,
no
exactly.
Way.
Yeah, exactly.
Yeah, so the way I look at this is a lot of people think lower interest rates, homes are going to go up. Higher interest rates, homes are coming down. That's not necessarily true because right now, a lot of the buyers we're talking to have a house that they refinanced a year or 2 years ago, and they're like, I'm not putting that house on the market. I'm probably going to keep it and rent it out. So inventory is so low, and inventory drives home values more than anything in demand, not interest rates. And so like Hugh said, there's a weak correlation here, but not a very strong correlation.
Yeah, that's right. So you could see housing prices be pretty buoyant even though interest rates are higher. So that needs to be something that's factored in when you're talking to your clients. Okay, so just wrapping up this episode, we just want to leave you with this last summary slide. Basically, there's
watch where you put your money.
Yeah, that's right. You got to, make sure you deposit in a credit-worthy institution. But the fallout from the Silicon Valley Bank is still ongoing. It's something that we're monitoring closely.
I mean, this is big. This is a huge deal. I know for us, you're like, what? Banks failing?
Like Jonathan said, this is the 16th largest bank in the United States. And
this is huge. This is going to be in the news for the next 90 days.
It's caused another bank to go under as well, the Signature Bank. So there's some stress on the financial system, and that could cause the Federal Reserve to pull back as far as its interest rate policy. Goldman Sachs already expecting the Federal Reserve not to increase rates at its next meeting. And then as far as real estate, real estate tends to hold its value over time and increase value on an inflation-adjusted basis. So that's something to keep in mind as you advise your clients on when it's the right time to buy. And then lastly, that last chart we're showing is basically there's a weak correlation between what home prices do and what interest rates are doing. So if you're able and willing and ready to buy, we generally encourage people to do that because you see home prices on an inflation-adjusted basis increase over time. So waiting doesn't always yield the best financial results. So we appreciate you tuning into this episode of Hugh Knows, and we hope to see you next time.
Later, guys.